What is a liquidity generation event? Well, simply put, it's just another word for you are the exit liquidity. See, when you become as old as I am, you find that terminology changes, but the definitions, actions, and results typically don't change. This is just something new I came across that I also wanted to highlight because it also emphasizes what I like to talk about, which is essentially understanding the mechanics. If you understand the market mechanics and market structure of the thing, you can understand what can, should, and will happen. Much like if you don't press that big red subscribe button, you'll miss out on being subscribed. So, liquidity generation events. Why do I say it's labeling you as exit liquidity? Well, I'll let you be the judge, but let's read something from the traditional finance world first. First, I'll bring you here, something called a liquidity event. What is a liquidity event? It's when a acquisition, merger, or an IPO, typically an IPO, that allows early investors, typically the founders or pipe investors, to cash out some, or if not all, their ownership shares. Now, the part where this gets shitty for you as a public investor is a liquidity event is considered an exit strategy for an illiquid investment. Now, if you needed more incentive to subscribe, there was a previous video I did talking about liquidity, especially with illiquidity and how it can hurt you. In this case, imagine if the founders and the pipe investors, they have like, let's say 10 million shares per whatever, right? Stock comes out, the price levels are atrocious, like 100 shares between all of them, like 20, 30 cent gaps in between all of them, right? But these founders, pipe investors, they have 10 million shares that they have to offload, where in a stock where it only does like maybe 10,000 shares a day or whatever, right? Now, if they were to dump that all at once, they would crush the value of the stock immediately because there's just not enough buyers there, because again, you need someone to buy it from you to offset their selling pressure. So in order to kind of counteract this, most of them will announce a merger, acquisition, or hype up their IPO in order to pass off their shares to investors. And these new investors, yes, they can, if these guys do it slowly, which I'll elaborate later, if these guys do it slowly, they can let these new investors come in and push up the price of the stock, and therefore they get a better return on their original founding shares. Now keep that last part in mind because it will be important later, but let's look at the crypto world and how they tackled it. The crypto world definition by a coin called Core, which I'm not too familiar with, they had a concept called liquidity generation events, and the first LGE was used to mint and distribute all 10,000 Core tokens fairly. The very basics of this is that there is something called liquidity pool or swap or whatever, right? Basically an exchange. So you're exchanging at a set rate for Bitcoin, Ethereum, whatever set dollar value that they have there or whatever, right? So when you're swapped, essentially the fee breakdown also on top of this, which will be important later, is typically maybe 1% to the liquidity pool for swapping this, or maybe they have their own liquidity pool, and then another small percentage for the developer fund. This also doesn't highlight certain little nuances, such as, the slippage that they get. Is it actual slippage, or are they just making that up? Because there's not a book there that you can actually see. What's funny about all this, and part of the point of my video, is that before it was called LGEs, it was called ICOs. What an ICO is an initial coin offering. Basically, it's a way for a company to raise funds to create a new coin, app, or service or whatever, and they're basically pre-selling you something that doesn't exist already. And as you can see here, a few ICOs have yielded returns for investors, which I can't think of any. Numerous others have turned out to be fraudulent and or have performed poorly. Now, I'm not saying all ICOs are scams. Some of them might have done. I just can't think of anything from my personal knowledge and from my research. I haven't really looked too deep into the ones that are successful because I'm mostly inundated with the ones that weren't successful. And typically, simply put, when you put money to an ICO, you're basically trying to buy something. It's like a Kickstarter. You're putting money towards a product that might not exist or a project that might not come to fruition. It's almost exactly like that. So you have the predecessor ICOs and the new meta, which is LGEs. The LGEs provide a new twist to basically extend the life either through lockups or through their liquidity swap, whatever. All of it results in the same, where you are the exit liquidity, because the only difference in selling a large amount of their worthless coin is time. Instead of doing it all at once, remember the thing I told you to remember from traditional finance, instead of doing it all at once, they're doing it slowly as to not spook the market and or crush the price in basically one go. By them extending that time scale, by them doing it slowly, they're hoping that you will convince yourself or others, or maybe they'll hire an influencer to convince others to put money in, so that not only will it maintain a certain price, it will actually potentially push it higher, making the payday just that much more lucrative for the scammers. Listen, at the end of the day, you need to do your own research and understand what you're buying. Keep asking questions. There's nothing new about the crypto world, what they're trying to do that the traditional finance world hasn't already had happen. Just look at MLMs, for example. A Ponzi scheme is illegal, but the MLM garbage isn't. How is that even possible? But it is. I get that some people are going to draw some parallels to this, to the real world, which I have, but crypto has no regulation. Someone making an offer to buy a company and then pulling out his shares at an inflated price with no intent to buy has legal consequences outside of the termination fees. What does crypto have? In closing, a large majority of them have the same basic outcome, which is you are the exit liquidity. But that's only if you allow it. Listen, if you don't want to learn from your mistakes or the mistakes of others, that's up to you, but just remember, just because you're a day trader doesn't mean you have to trade every single day.